Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. I hope everyone had a great Thanksgiving vacation or holiday as I did, because I certainly did enjoy myself, perhaps a little too much, as most of us do. But over the weekend, Barron's magazine had a very interesting article on essentially discussing the resurgence of IBM. And IBM is a stock that I do own in portfolios for a very specific reason. And I've invested in IBM now for many years. And I want to add, with no delusions about what I was doing, because I was using IBM very specifically for a purpose. It was part of a much larger portfolio, a very small part, usually a 3 to 5% position, depending on the size of the client's portfolio. And they were all, my IBM investments were made for those clients who were looking for current dividend income. They were living off their portfolios and using the income to live off of. And from the very beginning, I've considered IBM a very dividend payer. They've increased their dividend for something like 26 consecutive years now, and they've paid one for even longer. And as I'll get into when I get into the video, they have good cash flow coverage of their dividend. So IBM was invested in for the income, but also with the idea that eventually IBM would pay off. Now, as it turns out, and I'll get into the stock here in a moment, IBM is a quintessential example of earnings determining market price. Companies' earnings have been horrible, but the article in Barron's over the weekend was very enlightening. So let's go ahead and move in and look at the fast graphs on IBM and look at what I've been seeing and what I've been covering here. So the first thing I want you to note when you look at this graph here is that IBM has been dropping in, earnings have been falling now for several years. Okay, but the earnings are actually beginning to turn around, or expected to be turning around. And IBM's guidance with their new CEO has actually announced, and also partly controlled with the idea that they spun off the Kyndryl spinoff, which is their old legacy mainframe business predominantly. The company now believes that they're going to be able to grow in single to even high single digits, depending on what division of the company you're looking at. So Barron's had an article, and they titled it, and it was on November 28th, and it was titled, "IBM is finally growing again, and the stock is one of tech's biggest bargains." Now, the reason I was compelled to do this was because I do believe that when you compare IBM to the likes of Microsoft and Apple, and of course almost any of the other gigantic tech stocks, they are all significantly overvalued, in my opinion. They are trading at extremely high multiples. They offer little or no dividend yield, but they have been tremendous momentum investments. They've made people a lot of money over the years, including yours truly, although I do admit to selling them a little earlier than I should have. But IBM, in contrast, has been pretty much dead money. Now, this dot here, this represents my cost basis for the clients that are involved in IBM, and approximately the time frame that I've owned the stock. But the key is the price has not done very well, obviously. It's gone from 140 something to 115. But what has been positive, and I want to remind you, these are for people who are looking for current dividend income, and it represents a small part of their portfolio. And frankly, we're getting a great growth out of many of the other constituents that are in those portfolios. But in the meantime, we've received this 4+% dividend yield while we've been holding IBM. And that dividend, as you can see by following my mouse here, went from, $4.06 in 2014 to $4.78 to $5.25 to $5.64, $6.22 by December 20th, $6.40 expected in 2021, and then, expected to continue to grow. And I'll cover that in more detail. So we've had good dividend income growth. And I'm going to go ahead and shorten this performance graph here just to point out that the dividend has grown at about over 8% per year. Now, I also want to point out the more recently, and of course, part of that contributing to COVID, the dividend growth rate has slowed down a little bit, okay? But again, that's not to be unexpected. But what's really happening here, I think, is the earnings are beginning to grow, all right? And if I look at forecasting on the company, analysts expect very strong growth in earnings for the next couple of years. Now, I want to put that into historical perspective. after seeing earnings dropping in 2018, 2019, and kind of steadily dropping since 2014, as the article pointed out, IBM is finally growing again, expected to grow at over 21% this fiscal year. And that $10 forecast is pretty solid. I think it might be down to about $10 after the Kindle spinoff. That forecast is kind of dynamic right now, but it is expected, and the Barron's article pointed out they did expect IBM to earn about $10 this year, followed by 9% growth and 8% growth. So when I'm looking at those forecasts here going forward, this is a little more precise than what we have on the historical graph. I want you to note that there's a very strong margin of safety in the company. Okay, now the normal market value of IBM has been trading at around 11 times earnings. If I use the drop down here, you can see that for the last 5 years, last 3 years, last 7 years, if I go on all the way up last 12 years even, that IBM has been trading at a relatively low multiple, 12 to 14 times earnings. So I'm using a normal PE here, using the 5-year default, if you will, of a PE of 11.26 as normal. And given that number, if IBM were to basically generate that earnings growth and traded at that normal low multiple of 11%, I have an 11.8% total annualized rate of return over the next year, and I have a 12% rate of return going forward. Now, if I look at long-term growth is expected to be, again, high single digits, even higher by some analysts. And again, if I use that 12-ish multiple, I've got double-digit returns expected for IBM. In other words, the day looks like it's coming that IBM could become a growth story once again, that maybe the battleship has turned, the pages. And the Barron's article, you can go into the Wall Street Journal. I can go right into it from our external links here on Fast Graphs. You can go into the Wall Street Journal and you can see these articles. And, the main article is, here's the one from Barron's that I talked about. IBM is finally growing again. The stock is one of tech's few bargains. And then IBM is a bet on the future of quantum computing. That's a very interesting, this isn't a very profitable sector right now, but quantum computing is very, very interesting and has some very interesting aspects to it that could be a long future. According to the article that was in Barron's here, it says you won't quite find quantum computing showing up in any significant way on the corporate income statements of Wall Street models, but scientists are increasingly talking about its power, and it could one day become a material part of technology company results. IBM, pushed along by the 3,000 people inside its research division for quantum computing, is one of the companies leading the way, which offers a way to break through the limitations of so-called classical computing. Now, that's a little bit into the distant future opportunity, but it does show that IBM is in a position to potentially participate into some pretty interesting future growth, longer term over time. But the Barron's article that was the primary article, it said IBM is finally growing again, is one that if I go ahead and click on that here and just show it to you, you can see that they featured IBM in Barron's. It was a major feature here. It was, it was on the cover. They talked about IBM's new CEO very significantly in here and how important that, and I really have trouble pronouncing this, Arvind Krishna, I guess is his name, the plans he has for IBM. They talk in the article about where he came from. He's been a long-time employee of IBM, and he's really thinking big. And he was named chief executive in January of 2020, according to the article. And he was running IBM's cloud unit. And the cloud is where IBM's future is. And they have a very interesting take on the cloud. They have a hybrid cloud where they expect to even be doing business and potentially helping integrate the primary cloud people out there, like, of course, Amazon and Microsoft, et cetera. So, it's very interesting that the company is repositioning itself. And the Barron's article, and I don't know if this is a stretch or not, how many of you are going to believe this? I'm not sure I do. But the article points out but in fact, IBM is starting to look like Microsoft Junior. It has a new leader pulled from its own deep bench of talent. It has restructured its business. It has doubled down on the cloud and artificial intelligence. And next year, it is likely to start growing again for the first time in a decade, as I indicated, looking at the fast graphs here. And, one of Wall Street's few believers, and by the way, not everybody does believe that. I think it's important for me to point that out, says Microsoft is an interesting comparison. When I look at Arvind as a leader, that could be as transformational as Satya, which of course was for Microsoft. But there's an increased appetite, the article goes on to say, on the street to understand the trajectory of the business. He says of IBM, if the stock starts to move higher, you could get a performance chase. And that's one of the issues here. If IBM begins to gain momentum and they begin to generate some very strong earnings growth, the key is you probably won't see it languishing in these low valuations very long. And if you're looking for a tech investment with a 5.66% current dividend yield, you won't be able to find one other than looking at IBM. Earnings yield is 8.52%, and it's currently be bought at 11.7%. And that does provide a margin of safety from what I would call a rational value. And it does provide an attractive valuation if you were looking at the discounted valuations that Mr. Market has been applying to IBM over many, many years. But now what I'd like to do, so I would suggest you read those articles and start doing your own research, because, the article also pointed out some of the negatives, like the fact that they missed the earliest cloud opportunities. But the company eventually realized that its software could be the glue that held the various parts of the cloud together. It says, 5 years ago, everybody was saying that one cloud is sufficient, the new CEO reported. But IBM concluded that cloud-based world would always be more complicated, and it has been wisely planning for a hybrid future ever since. They have strong relationships with financial services companies, which were early to embrace the hybrid cloud. And that's really IBM's sweet spot now. So this is a very interesting and intriguing company. But now let's go in, let's look at it from a standpoint of fast graphs, look at trying to evaluate it as a quality health check, we like to call it. If you recall, there's roughly 17 points that we cover. Now, the first 7 are seen on the fast graphs. That's where you're going to look at. Let's go ahead and do those real quickly before I get into fun graphs. If I look at IBM from an earnings point of view, we can see that this was a very strong grower coming out, between the last 2 recessions all the way in to 2014. Then we've hit this spate of problems. Now, remember, the company has spun off Kyndryl, which, by the way, I sold because, as I mentioned in the beginning here, I bought this stock for the dividend, and that's all I'm interested in. Kyndryl doesn't interest us at this point. I'm going to follow it and see what's, perhaps the promise is, but I think that's a long-term turnaround for Kyndryl. I think IBM is now positioned to be able to generate this accelerated growth that people were talking about. And it isn't really affecting their income, because the Barron's article also pointed out the strong cash flow growth that the company has and the cash flow opportunity growth. Now, when I look at IBM from a standpoint of operating cash flow, and I'm going to take price off of this graph because the key point here is, as I mentioned, we invested for the income. And as you can see, operating cash flows, the white line here is the dividend, and the payout ratio of cash flow has been in the 30% range. And I consider the dividend extremely well covered by operating cash flow. But even more to the point, free cash flow has been strongly covering the dividend, and it's been much more stable than earnings, both operating cash flow and free cash flow. And I can go through all the other valuation metrics here, and I can bring price in. From a price to EBITDA, the company's trading at a very low valuation. From a standpoint of price to operating margin, or EBIT, it's trading at a very low valuation. And importantly, from a price to sales point of view, it's trading at a very, very low price to sales currently. In fact, if the sales continue to grow, forward price to sales could get close to 1.08, I think the article pointed out. So it looks very attractive there. But let's go through the fund graphs, or the fund financial underlying numbers remaining health checks. And it starts with share buybacks, number 8. Now, what's important here is IBM has been buying back their stock aggressively. You can see this. Now, one of the things that we do with fast graphs, we believe share buybacks are a good thing if they're valuation based. All right. Common refrain is that companies can reward their shareholders through either buybacks or dividends. And of course, IBM has been a great dividend rewarder. They've raised their dividend for over 25 years. Dividend growth rate at times has been spectacular. It has slowed down a little bit, but again, the earnings growth starting to accelerate. And so our cash flow grows, free cash flow especially, we could start to see the dividend really growing at a much more rapid rate going forward, as well as the stock eventually getting momentum. So I think there's a lot of opportunity here. But I think what's important is if you look at IBM's buyback record, okay, they pretty much maintained their share count, we'll say up through 2004. There was minor buybacks, which sometimes company use just for company, work options and so on and so forth. But the reality is that if I measure that according to IBM's valuation based on earnings, the stock was very expensive through 2005. And to the company's credit, they weren't really reducing their share count. But then as we start getting into the Great Recession, we have this long extended period where the price is below the orange line and even below the normal multiple for this time frame, because there was a time when IBM was trading at 20 multiples. And that hasn't been that long ago. Even coming into the Great Recession, it was trading at a 16 multiple and actually got up to a 15 multiple while we had earnings growth. So I don't think it's unreasonable to expect IBM to return to a 15 multiple going forward. But nevertheless, as I look at all of this time frame here, this time when IBM has been aggressively buying back stock, it's been doing it at a time when their valuation makes sense, or their valuation was very low. And again, this is a turnaround situation. So that's very important to recognize that. Now, I already mentioned cash flow from operations. And another thing that I like to see, and we like to see, is we like to see cash flow from operations be very, very, so let's start with net income here, and then net operating cash flow. And what I want to see is, I want to see operating cash flow higher than net income. And we have that. In fact, it's actually improving and getting a lot better here in recent years, where we do have operating cash flow. And I already showed you that significantly higher than net income. So that's healthy. Now, the sales growth trend over the last 3 to 5 years, if I shorten this time frame to 3 to 5 years and, bring this down, and I'm using the in millions now and look at sales and revenue growth, it's actually been negative. All right. Now, if I move into per share growth, it's been a little more positive. It's still slightly negative. If I actually, shorten this time frame a little bit, you can see that it's actually grown a little bit from 79 coming into 2019 to 82 billion. And then, of course, COVID, came and it's had a drop. But looking at quarterly sales, we're beginning to see quarterly sales increasing again. And again, according to that article in Barron's, they're expecting that to be, very, very strong going forward. So the next thing I want to look at in addition to sales growth is let's go ahead and look at net income growth. And net income growth has been, let me go back to the yearly trend. Net income growth has been really poor for the company, just like earnings growth was for all this time frame. That was, it's not unexpected to see that. There was a time when the company was growing net income, at a very high rate. We're starting to see some improvement in that when we're starting to look at quarterly numbers, but that would be a negative. Now, from the debt to equity ratio, I'm just going to stick with fast graphs here. The company has 60 cents of debt for every, 40 cents worth of capital. So, I'd like to see a debt to equity ratio of 1-to-1, but here we've got less than that. It's got a much higher amount of debt, and that's been a drag on the company for quite some time here. But on the other hand, if I go back into the in millions graph here, and I look at the company's total debt on the balance sheet, and go ahead and look at the company's total debt, and then look at their total equity, it's starting to improve a little bit, but it's obviously very high. So this is a negative. However, one thing that I do think is a positive here is if I go into the ratios graphs here and I look at the profitability ratios and I look at gross and net profit margin, I'm starting to see some interesting pictures here. We're starting to see net margins increasing again after being down for several years, and gross margins starting to increase again. So I consider that a positive. The company is perhaps turning themselves around, as the Barron's article kind of indicated. Asset turnover is another one that I like to look at. I like to look at asset turnover. And here what I'm looking at, I'm going to go into the income statement, and I'm going to look at sales and revenues, which is what we're looking at, divided by total assets, which I'll find here in the balance sheet. What I'm seeing here is that the companies, for every dollar in assets, they're generating about 50 cents or so in sales, and that's not too bad. I think that's okay right now. Now, return on assets, if I go back into the ratios graph here, and by the way, we are working on a tab where we're going to make all of these ratios available to you when we launch the new product, that really just be able to go through them. We won't have to go through this process that I've been going through here. So if I'm looking at some of the profitability ratios again, and I'm looking at things like returns on assets, I'm looking for a return on assets typically of 10% or better. We're under that right now with IBM, but hopefully that's starting to improve and will start to improve in the future. I don't have quarterly data loaded yet. So return on assets is a problem. Return on equity, I do like to see return on equity of 15% or better. And again, we're getting that from IBM right now, so that's kind of a plus. Again, this is a company in transition and a company that's essentially turning itself around. So, I also want to look at EBIT to sales or operating margin. So I'll go back into the millions graph here, and I'm going to go into the income statement, and I'm going to look at EBIT, and then I'm going to look at sales and revenue. And what I see here is, and I've got one on the balance sheet, let me get rid of that for you, total assets. And what I've got here is I've got a pretty good number. My operating margin is decent. It's almost double digit here, and I kind of like that. So I think, all in all, there are some issues with the scorecard, if you will, the quality index check. IBM has clearly had some issues. There's no doubting that. I think this is really an operating cash flow and free cash flow story covering the dividend that is now beginning to turn around and go back into a growth story. And I think that's the real key. And, this reminds me of something I've talked about in the past to people. As a value investor, one of the things that you've got to have is intelligent patience. I never invested in IBM with the illusion that I was going to make a great deal of profit on it initially. I was going to let other holdings in the portfolio give me the profit. What I wanted, what I looked for, was a significantly above market yield, which this gives me. The over average stock is yielding less than 1.5% right now. I could get, right now, if I bought IBM today, I get 5.56. I've been averaging around 4.5% to 5% during the time we've held it. And that's distributable income that the clients are spending. And even though we're down just a little bit in IBM, our record has not really been that horrible. And if we get some growth coming up now, the intelligent patience could pay off. But IBM was utilized for a purpose. And I do believe this is a great American company. It is a behemoth, over $100 billion in market cap, obviously, and it has the potential to begin growing again with the hybrid cloud business that they're doing. And then, of course, in the future, you've got a potential kicker with the quantum computing, et cetera. And now that the mainframe part of their business has been spun off through Kyndryl, that's been a big drag on their business for a long time. We've got this. Now, Kyndryl didn't work for income investing. That's in the Barron's article actually talks about that. The fact that investors that were investing for income weren't really interested in Kyndryl, and I agreed with that. But I still like IBM. I love the valuation. I love what I see going forward. And this is a stock that I could be adding to and probably will be adding to as I, reevaluate coming up in the new year what my dividend income, growth and income portfolios are looking like, because it's pretty hard to turn down that yield. And, with the Barron's articles and the indication, if we start getting some momentum in the stock, this could be an ideal time to start looking at IBM more closely and taking a position before it's too late. It's the oldest saw in Wall Street, buy low and sell high. And, you don't want to wait till the good things happen. You want to get in before they happen. And I think IBM provides that opportunity. Thanks for watching. I really appreciate it. If you like this video, give me a like and give me ring the bell if you want to get notices of new videos coming out. Subscribe to the channel if you haven't. We're real close to having over 30,000 subscribers. I want to thank all of you for that. That's exciting. We are on track to launch this new version of Fast Graphs. It'll be a beta launch, by the way. That means there'll still be some things that aren't maybe 100%, but I'm going to call it 99.9%. It's a vast improvement over the current Fast Graphs, which I consider to be as fine a research tool available out there today. And so, we're real excited about it, and we'll be announcing it, and we'll be putting out some tutorials on it and, bringing you up to speed. But, we're looking to launch it on December 5th. So anyway, it's been Chuck Harville saying thanks for watching. As always, you're greatly appreciated. We'll be talking to you again very soon.